Rahul Singh, who is joining us now from Tata Mutual Fund. Rahul is the CIO there. Rahul, good to have you on the show. I was really looking forward to our discussion, especially in the light of the latest development. Because there is a message of sorts in the decision which your house has actually taken of stopping the lump sum investments in the small cap space. I want to understand the thought process out there and why right now.
Yeah, thank you for the question and thank you for having me. I think, I would just like to break this into two parts. So as the markets are broadening and as the economic growth is spreading to the other areas which are not done well, like manufacturing and capital goods and so on, we are bullish on small cap as a space. If you take a 3 to 5 year view with so much happening in the economy. However, we have a responsibility towards our investors, and we also felt that the current market liquidity does not really support the kind of flows which where we were getting either in the category or in our own fund in the small cap. So we decided to take this decision to stop the lump sum flows, but the SIP STP route to continue. Because what we don't want, and which is what is productive for any investor investing in mutual funds or especially in small cap mutual funds, is a significant surge in inflows which forces the fund manager to take certain hasty decisions and make mistakes. So therefore, we want to avoid that scenario. We want to calibrate the flows to the extent we can deploy. And I think that is something which we think is ultimately in investors' interest over the long term. This is not to say that we are seeing significant euphoria or a significant bubble kind of a situation. This is not that message, but this is a message to say that the extent of flows were not being matched with the extent of liquidity or the opportunities we were getting. So we want to match the two. I think that's the main objective of taking this decision.
Important point and very important clarification as well, because the first point which you made, that you continue to remain bullish on small caps on a 3 to 5 year view, and that's how it should be seen. But sometimes a lot of money chases smaller stocks in a very small period of time, and that's what causes the disruption for investors and of course additional headache for the fund manager. So it's a prudent measure which you've taken, risk management. Let's talk about overall market valuations. There are voices now saying that in the extreme short term, a lot of good news seems to be getting baked in. But if you look at the economic review which finance minister has put out today, or in general the economic data, they seem to be still pointing to a direction which is taking off, and a direction which is actually looks very healthy. In the extreme short term, near term, do you see there's a mismatch between market cycle and economic cycle?
Not really, because what we are seeing clearly is that India is in a sweet spot with some kind of soft landing in the developed markets. We are not seeing a crash landing of the economies. We are seeing a soft landing, which is a sweet spot for India because commodity prices remain under control, our macro parameters remain under control, and the corporate sector is in the best of its health it has ever been in terms of leverage. Banking sector is in its is the best of its health, especially if you compare it with the developed markets or China. So all that is getting baked into the premium and not just short-term momentum. How much that premium should be, whether it should be 10% above fair value or whether it should be 60% above emerging markets or 80% above emerging markets, is not a perfect science. So therefore, I would say that while yes, there is a little bit of valuation premium which has got baked in because of these factors, we don't yet see that it is completely unjustified or unsustainable. There might come a point where I would say that it becomes completely unjustified or unsustainable. This is not that point. Having said that, we also have to do our jobs well as a fund manager to avoid certain areas where we see unnecessary optimism or unnecessary euphoria, and be in those sectors or stocks or companies where we still have valuation comfort and there is room for an upside. So I think the job of an active fund manager becomes extremely important in these scenarios where valuations are fair value or slightly higher than fair value, and therefore bottom-up stock picking becomes all the more important.
True.
And to just summarize the whole thing in the context of the fact that the economy is broadening in terms of the parts of the economy which were not doing well, especially pertaining to investment cycle, now beginning to do well. There are more opportunities coming up in sectors or segments or stocks which have not done well over the last 10 years or in the previous decade. So if
Fair
you
point.
put a combination of all these, I think it's still a pretty interesting market to try and create alpha despite the headline valuations not being supportive.
Fair point. That's also a point taken. Let's move on and talk about some areas of the market which seem to have come alive after a gap. PSU Banks is one such space. What is your analysis of the PSU Banks? In fact, today, PSU banking chiefs and finance ministers meeting to set the new targets, new business targets for the fiscal. And this comes on the back of the fiscal gone by. Many of them performed very well on financial parameters. How the valuations are looking in the investing case for some of these PSU banks, in your view?
Well, banking in general has had a you know, perfect scenario last year. Some of that is getting diluted with NIMs potentially coming under pressure, but the credit quality or the asset quality is very, very strong. Growth is still continuing at a fair clip. And typically what you've seen is that any asset quality trouble comes after 3 or 4 years of such high growth or high credit growth. So we are far away from a potential bad asset quality cycle. So if you look at in that context, the valuations for some of these banks, including the private sector banks and PSU banks, they are still in the reasonable zone. They have not reached, higher than the fair value, or they are not trading at higher than their historical valuations, except a few stocks. So there is room for alpha there in banking as in general. And also, I think over a period of time, because of the systems and processes being put in place by RBI and the banks themselves, the difference in the in the asset quality between the best bank and the worst bank, which used to be there, say 5 years back or 10 years back, that difference will also be lower or lesser when the next asset quality cycle comes. So all that is, getting reflected in not just PSU banks, but also in the performances of the small, mid-sized private banks also.
Rahul, what are your thoughts on the auto space? I don't know whether you have been a biker in your college days or not, but you must be watching that space very closely. Especially the bike wars happening between Hero, Bajaj, and Aisha being dumped because of that. Generally, how are you looking at the competitive landscape evolving in the two-wheeler space? Because Bajaj has come back to its life highs. Hero is at a multi-year high, TVS too. So there seem to be some interest back in two-wheelers.
Yes, I think what we've seen over the last 2-3 days is interesting because I think it's also going to expand the premium bike market. So while obviously market share movements between the players can happen and depends on how well the new entrants execute and how well their products are executed, we will know as the time goes by. But one thing is for sure that with these price points, the market itself will expand for the premium bikes. So premium bikes, which were, 350cc and above, which were a small part of the market, will become a meaningful part of the overall two-wheeler market. I think that's the other thing to keep in mind and not just get bogged down by just the market share movements. So I think that's the interesting part of what has happened over the last 3-4 days. So when the dust settles down, I think the debate will shift to how big that part of the market can be in two-wheeler and whether that can be the new trigger for the companies to start growing, because the core segment obviously is reasonably well penetrated and the growth is not as exciting as it is in some other parts of the auto market.
Right. One last question I want to understand is on the export, or I would say for, overseas kind of plays, pharma exporters, IT. Opinion is quite divided on IT, whether the time is ripe to get in there or not, or a few more quarter of weakness. Where do you stand on these two?
So IT, obviously the initial fear of sharp cuts is not really materializing. So there is a little bit of a equilibrium today between the global fundamentals and what the companies are able to achieve in terms of deal wins still. So it's not been a total collapse. Having said that, we also don't see an immediate recovery in the, say, big recovery in the deal pipeline or in terms of top line growth, etc. So it's probably a wait and watch sector as of now, but it's obviously not turned out to be as dramatic impact, negative impact as one was initially fearing. And also part of it is because, as I may initially mentioned, there is a soft landing which is happening in the global economy. It's not really a sharp cut or a deep impact on the economies which was initially thought of. As far as pharma is concerned, I think it's a totally different animal. There are totally different variables which are at play. Some of the initial stability signs are there of generic pricing declines moderating, but still early days. So we are watching that with interest.
All right, Rahul, always wonderful to chat with you. Thanks for your time this afternoon as well.
Thank you, Ajay.
That was Rahul Singh of Tata AMC. But moving on, that important meet